Hi everyone, my name is Rou Urn and I'm the LNG editor based here in Singapore. Welcome to the all-new Power Generation Fuels Market Wrap, where we will take you through the latest developments around Asia. The key highlight of February was China's imposition of 15% tariffs on US LNG exports. Although this is unlikely to have a significant impact on LNG prices in the short term, it could at least keep prices elevated by limiting the pool of tradable cargoes in the market, since the tariffs will result in China essentially being unable to take US LNG. But in the longer term, participants are still hopeful that tariff exemptions could be granted, or that both countries will ultimately hammer out a deal to end the current standoff. Meanwhile, Asian spot prices in February has been continuously driven higher, mostly tracking stronger European gas hub prices or the TTF. This is despite very weak demand from end users in Asia. Resultant higher prices have sidelined even more of them, even as some South Korean importers were compelled to buy spot cargoes to replenish inventories after a particularly cold January. But prices eventually came off again in mid-February, yet again tracking softer European gas hub prices. This raised the possibility of more Northeast Asian buyers returning for spot purchases. Thank you, and now over to Andrew for coal insights.
Thanks, Rou Urn. Hi everyone, Andrew here. Good to touch base again, and I just wanted to spend the next few minutes talking about the Asian coal markets. A few days ago, Indonesia, which is the world's largest thermal coal exporter, tightened its rules on export sales proceeds for commodities, including coal, as part of broader plans to boost the country's foreign exchange reserves. Indonesia recently extended the onshore holding period for export sales proceeds and raised the quantum of earnings that should be held in special deposits. Exporters of national resources, except for oil and gas, will be required to place 100% of their foreign currency proceeds into a special deposit account of a national bank for at least 12 months, according to the new government regulation. This marks a significant increase compared with the initial regulation, which required exporters to place only 30% of their foreign currency proceeds onshore for 3 months. The new rules, which were first proposed last month, will come into effect from 1st of March. These new rules have triggered questions from the industry on whether or not there will be any impact on coal production and supply. But there is a view that the new rule may only have a limited impact on the seaborne coal market, as exporters will have access to their funds to meet operating expenditure. Coal suppliers could have their proceeds converted to rupiah to pay for operational costs and maintain business sustainability, according to the new rules. The foreign currency deposit can also be used for payments of non-tax state revenue obligations, such as royalties due to the state for coal mining companies, it added. The non-tax state revenue obligations are in US dollars, as royalties are based on the coal reference price, or the HBA as it is known, which is published by the Indonesian Ministry of Energy and Mineral Resources. Coal companies will also be allowed to use the foreign currency account for payments of foreign currency dividends and the repayment of loans for the procurement of capital goods, as well as for the direct purchasing of goods and services which are not available domestically. The response from the coal industry has so far been mixed, with some coal producers and suppliers pointing to the potential increase in financial costs, although the impact on overall production and exports could be limited. That said, the new regulation could prompt coal producers to borrow money to meet some of their working capital needs, which could lift financial costs even after adjusting for the income from the deposits. Small coal producers might face liquidity issues, although large coal producers could continue to focus on meeting production targets. The low calorific value GAR 4200 kcal per kg Supramax market was last assessed by Argus at $48.09 a tonne on a FOB Kalimantan basis on the 14th of February, the lowest since mid-April 2021. Indonesia's seaborne thermal coal shipments are facing disruptions as heavy rains have weighed on production. Output may be further pressured in March as mining and logistics activities slow during the Islamic fasting month of Ramadan. The country's average coal production from December 2024 to the 19th of February this year is around 1.6 million tonnes per day, according to government data, but this is down from 1.98 million tonnes in December 2023 to February 2024. Output could reach 148 million tonnes in the 3-month period ending in February, but this would be down from 180 million tonnes a year earlier. This is according to Argus estimates based on government data. But production data is frequently reviewed in Indonesia because of delays in gathering information, and the actual output could be higher than estimated. Indonesian coal exports reached an all-time high last year, largely led by strong demand from China. The world's biggest coal exporter shipped 50.62 million tonnes of coal in December 2024, taking the year's total to a record high of 557.76 million tonnes, which was up from 521.1 million tonnes in 2023, according to customs data. And that brings us to the end of this month's Power Generation Fuels Market Update. Thanks for listening, and see you next time.